All right, good morning, everybody. We're getting a little closer to the tariff date, but if you look at the vol structure, April 4 has shown that it's very likely going to be more impactful than April 2nd. So it just goes to what we've been saying. Don't get married to that April 2nd date as the end of everything or the solution to everything. They're likely going to continue to front run that like he did with auto tariffs yesterday. And we could get some overshoot on that. It could end up on the other side too. So they're calling April 2nd the, they had a cute little name for it, but it's the tariff deadline. And yet it's still not the end of everything with that vol structure. Um, I got a good picture that I'll end up sharing into the chat with it, kind of highlighting what I'm talking about. Right here. So I circled the date 4/4. This is where my mouse was hovering over that spot. You can see how it rises up to this level, the highest spot. We've got jolts, jobs, ADP, ISM, and then we've got non-farm payrolls all tucked in there as well. So it's not just April 2nd. It's all the way out to April 4th. Then we start to decline more from there. Of course, this will change its shape as we get closer, and some of these later ones may start to get elevated, but we work with what we've got, right? So looking at what's going on around the world, Hong Kong slightly green at 0.25%, small caps green, but basically flat with the Dow. S&P down 0.25%, and the NASDAQ down more than 0.25%. The UK down more than 0.5%. So, for the most part, we're just down around the world waiting on what's going to happen next. We've got a lot of stuff coming in today. A little bit of job numbers. This isn't the big one. Then we're going to get some trade data, housing data, some feds out there chipping teeth in the later part of the day. We've got auctions today as well, and data coming out of Europe, even in the later part of the day, which we don't usually get too much of that, right? Usually if Europe is going to be interrupting us, it's before their own close. So watch later in the day around 2 o'clock, because we've got European central banks that are going to add to the Fed speakers that are chipping their teeth today. Manufacturing data, and then some overnight shenanigans from Japan. Got the 10-year headed to the upside, and we were really correlated with the 10-year. I showed that the other day, drew the red boxes out, highlighted the nice expansion that we had in the 10-year that matched with the ES. But we got a little bit of a divergence going on now because the 10-year broke above that 4.36 and it continued to run 4.389. But the ES flipped around and went the other direction. And we still aren't getting a whole lot out of the dollar, but in the grand scheme of things, we don't want that dollar making big moves anyways. So it can just stay there and continue to look pretty, smile for the camera. It doesn't. We don't really want much out of it, but we definitely don't want to see it running back up. When I shared the levels today, I highlighted in yellow a bunch of levels that are below the put wall. Now, the way that all those levels from spot gamma are put together with an algo that just goes in and spots and does the math. And they can be temporary, just 1 day little blips on the screen that are gone again tomorrow. So usually when I see significant changes to all of those levels, I pay particular attention to the founder's note that day to see if they highlight any of those that may be temporary. And they do a really good job of pointing out, hey, we think this is temporary. This one will be here for maybe a day. Don't get comfortable with this one. We don't have the AM edition yet, but when we get it, that's one of the things I'll be looking for them to speak on are all of those levels that are below the put wall that we now find. It's very likely that one of these lower levels will end up being the new put wall. That's my base case argument at this point, but we don't know for sure. I'd really like to hear what they have to say about it. One thing they did say last night is that in the SPX, under 5,700 is negative gamma and a high risk. And in the overnight, we went under that level and then we came back up. I know we can't see that because the SPX isn't being charted in the overnight on a US platform, but it is moving. The SPX is traded overnight. Just most US brokers don't offer it to US clients, right? So we cut underneath it. We got back above it. This is the picture that represents that. I went ahead and added that yellow box just to bring the strike all the way across. So that needs to hold, right? Because that's what they're calling a high risk level. And under that is where we have primarily negative gamma. If we think about what we could hit on the way down or, any levels that could help us out, I added the bubbles just because the picture doesn't really give you a chance to spot where all of these are at. This is where I had my mouse, that 5,700 level. We can see the cumulative put gamma and the cumulative call gamma. And we just see this very large level above it. We got 5,750, 5,800, and then of course, way out there, 6,000. But below us, 5,650 and 5,600. I'm showing this because I get a lot of questions on those pictures that I share every day, something that looks like this. And if you're trying to figure out, where do these levels come from? It comes from that last picture that I just showed with that gamma levels on it. I mentioned that there's a lot of levels below the put wall now that I highlighted in yellow. It's all of these. Now on the SPX, we're still underneath the volatility trigger because it shifted. Then we've got zero gamma, and far, far away, we've got a call wall, 60.50. It's not really going to help us at this point. We're back below the 10-day. We're resting on the 3-week. And if that breaks, we really don't have much below us to help us out other than the put wall at basically 5,700. There's been a lot of talk about the volume and the lack of volume, really, over the last few days, which I find interesting because most days I don't hear people say boo when it comes to volume. You never hear about it. But I guess if enough people talk about it on social media, then you'll start to hear about volume. It does help to pay attention to whatever product you trade, whether it's the ES, the NASDAQ, coal, gold, it doesn't matter what it is, so that you have an idea of what the average daily volume looks like, so that you can also spot when we're below average daily volume or above average daily volume. And I continue to try to help people understand that the micro NASDAQ, the MNQ, generally gets an average daily volume greater than the ES, greater than the MES, and greater than the NQ. I know that may surprise you if you don't look at volume every day, but the micro NASDAQ is the most often highest volume product out of the four. You wouldn't think so looking at the way it jumps all around the dome, but it is. So know your product, right? On the overnight, we're looking at about 94,000 in the volume. That's well above the average that we've seen over the last few years. But looking at the last few weeks, 94 actually comes in a little light. So from the future standpoint, we're well within normal boundaries of what volume looks like. But a lot of the headlines we've seen have been, more referencing SPY and SPX versus the futures. Still, there is a lack of participation in the grand scheme of things, and that all circles back to the lack of confidence that's been broke. And we're seeing more and more headlines on that too. That there was a Fed speaker yesterday that said they hadn't seen this lack of confidence since COVID. It's that bad. And if you don't have confidence, then you're not going to have large money swooping back into the U.S. markets. With the move that we saw yesterday, we have an expanded average daily range. It's still 110, but we've gone a little past that now. Since we're basically flat on the morning, we could go to either edge, but to get to the downside, we'd have to actually break outside of yesterday's range to do that, but we can hit the upper edge without even getting a breakout. So from that point of view, it makes it seem easier to hit this upper line than it does the lower line. It doesn't owe us a move in either direction, especially since we're flat. The upper line is on a cog line, but we're resting on basically 57.50. It's a big options level. Below that, 57.32, 57.11, round number 5700, 56.92 cog line, and then 56.82 for this red line down here. So we would have to hit all of those levels, break through them, continue to fall lower to get to this one. Can we do that? Absolutely. Price can do whatever it wants. But it's more likely that we hit the upper edge because there's just not as much stuff in the way as opposed to hitting the lower edge. But when it comes to news, when we get news this morning, it's not going to matter, right? News doesn't care about pivot points and cog lines or anything else. It's just going to push until the initial push is done, up or down. And it's very likely that we're going to see some volatility this morning between GDP and job numbers. So we want to focus on after that. It is also worth noting that in the move down in the overnight, we didn't get to Friday's close. So we still have that weekly gap up at this point. That's a gap that still needs to be closed. We did get inside the channel if we mark where we opened on Sunday night. We got inside that channel, we came back out of it. So it's very likely that if we get back in that channel, one, it would mean that we broke below yesterday's low again. And then we're in the channel, and it's more likely that we're going to go to Friday's close to get that weekly gap closed. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish, but we haven't hit it yet. And that gives us an MDP for tomorrow, missed daily pivot. The base case argument is that we're going to go up and hit that pivot today because that's what price does 80% of the time. It wouldn't be bullish to see us run up and hit that. It would be more of just price being mechanical and doing what it's supposed to do. We could go up and hit it and then reject. But at this point, since we got inside the channel and we weren't able to hit it, it wouldn't surprise me a bit if we never hit it today at all. That'll be a missed daily pivot for tomorrow. We'd use it in the calculations. Today's channel is pretty wide, and a wide channel implies that if we break out, it likely doesn't stick. That actually goes against the gamma at this point and the fact that we're in zero gamma or below the zero gamma line. We're in negative gamma. So I would say if we do break out to the downside, it could absolutely grow legs and it could stick and we can run. They just came out with the AM edition. Obviously, I haven't had a chance to read it because I've been with you guys. But I'll get that shared and you can start going through it. Get ahead on things. With that talk about the downside move with Friday's close, the weekly floor pivot is right underneath that level on a cog line, 57.11. So it's very likely if we get inside that channel that we're not only going to go to Friday's close, that we're going to overshoot it and we're going to hit that weekly pivot. And it's a cog line anyway, so even if there wasn't a pivot there, I would expect to hit the cog line. $57.11 is last week's point of control. Below that, we've got $56.50 as a point of control for the week before that. Really not a lot down here that's going to help us out. All of this has a lot of structure. They've just been putting in a lot of work down here. The concern is when you see them put in a lot of work and they don't get a lot out of their results, is that they're just going to give up and wash it. If we look at our current week, you can see where they put in all that work across the top. So that we built our own resistance this week. And now if we do want to make a run to the upside and continue this drive up into the halfback that we've been talking about, we've got to get through this very new resistance that we just built this week. At this point, it really doesn't seem like we're going to hit that halfback. This is what we've been focused on. So from that measure, I guess we did hit it, but I could have swore there was a 5,900 that we were focused on. Very likely. I'm getting my numbers mixed. That's very likely. So there's our halfback then. We got it. That's it. Maybe we get one more hurrah at it and, challenge those 50 period moving averages and get into 5,900, but why would we, right? We reached our target. We hit the halfback. At this point, that's all it owes us. We are resting on the 200 period moving average, but they're not designed to be support and resistance. So we wouldn't expect it to continue to hold price. It's supposed to either bounce off of it and continue on or bounce off of it to rise up a little bit before it breaks down through it. We spent a week fighting that 57.50 level. And when we finally got through it, it needed to hold. So if we break that level and we get back down beneath it, then I think we get a chance to retest lows on the year. And then we can measure this entire range and project that to the downside. 54.32 cog line. Imagine that. $10-day, 30-minute volume profile with TPO. We got a lot of volume across the top, not a lot of trades across the top. Right. So those are just indicating that while there was less trades, there was more contracts per trade at those highs. So big player participants. Really expected the point of control to be up at this level by today. That was really what I expected. It's not. And now we're not going to get into the volume that created that level for a few days. It's right in here. So, we're not going to be taking any of that volume off. And now the only way that it's going to move in the next few days is if we run back up to this high volume area at 58.20 and put in more work, or we drop down to this other area at 5,700 and we build that out enough. Otherwise, the point of control being at 56.75 is likely going to be there for the rest of the week. We would start getting into those candles next week sometime. When that happens, if we don't get back above this 58.17 by then, it will by default become the new point of control, and that'll be over our head as a resistance level. No VPOC from yesterday. You can see the work they came in yesterday trying to hold us up around that 57.80 area. They weren't able to get it done, but they did put in a lot of work trying to get it done. Once that failed, then of course, we got the next run down. Point of control at the low of the day. One, just because we spent more time down here than we did up here at this level, where they also had put in a lot of work. That was defending it against the previous day's low, right? They put in a lot of work there. It didn't help them out. But we spent more time down here than we did up there. That's where our point of control is. It's now the area that we've got to get through, 57.50. This morning, our own point of control is lining up really close with that. Not really much discrepancy between these two this morning, indicating that for every trade we've been putting on, we've been getting the equal volume out of it. So a bunch of little trades rather than those really big ones that we had spotted on the 10-day. And we're back inside the box. We can still see the gray line below us because we haven't got back to Friday's close. That's still what we need to do so we can close that gap. Still below the 10-week. Shows that we're stair-stepping back towards the 10. Still haven't got there yet. The concern is, if we look back, that we don't get there. We get close and we end up fading away from it again. Same thing here. We get close and then we end up fading away from it again. That's the concern. Otherwise, what I like to see is when we're a long ways away from the 10 and we run and jump that in a single shot and we're above the 10. Same thing, we're a long ways off. The next day, we're above the 10. But that's not what we got. So be cautious of the idea that we may not get to that 10-week and that we could, flip over and start fading back farther away from that 10 again. For the 10-day, we got to the edge a little past 1% before we started to fade off. And now if we were to zoom into this a little bit, we're back below that 10-day. See the little nubby down here. So just barely, you could basically say we're at the 10-day at this point, which does have a bit of a gravity around it. 1/4%, 1/2%. We need to get beyond that 1/2%. Otherwise, we can just sit there and chop. So we're in the zone. That's not necessarily a bad thing. Markets can digest and like heal around that 10. If we look at things that are down this morning, bonds are down, chips, semiconductors, and nat gas, which whatever, don't care about nat gas. Gold miners down, up. China's up. The VIX. The negative volume in the Mag 7 is up. I know it's like a brain twister. So we're talking about negative volume that's positive. And Bitcoin is moving in the right direction. It's just not up enough to meet our qualifications. So this is TradingView. I set my screener to 1/2%. And if we look at the NASDAQ 100 and names that are down at least 1/2%, we've got 19 names that are down. And if we look at the industry of those names, a lot of semiconductors, right? So that matches what we were just looking at with the ETFs. Chips are down. Take a look at the S&P. Things that are down 1/2%. We've got 9. A couple of chips, but otherwise it's not really highlighting groups too much. Look at things that are up. It shows Ford and Tesla up. Could have swore I seen Ford was down more this morning as a part of all the car tariffs and all of that, but either way, Ford up, Tesla up. And for the NASDAQ, we're not really seeing much of a group again. So collectively, if we're looking at what's up and what's down, chips being down as a group has more weight than anything else. And for things that are up, China being up is good. Collectively, that's a group that we can trade, the whole ADX complex. Baba, Baidu, JD, PDD, all those guys, right? Billy, Futu. But that's not going to help us out when we're looking for what could move the S&P and the NASDAQ. So tradable, sure, if you're looking for intraday trades in equities, but it's not going to help the futures or the S&P and the Qs move. Gold miners, same thing. If it's a sideways day in the S&P and the NASDAQ and you're trading futures, trade some gold. From a swing trade perspective, we got that breakout on GDX, and then it just stalled up there. It could digest that spot for a while. But if we look at it on the hourly, it's at the upper edge of that digestion. Could look for another breakout above from there. I'd rather catch it on the lows, of course, but you play what you can get. If we break that 44, though, then we're going to really start focusing on getting back to the anchored VWAP down here. Same thing with silver. It's up this morning, but it hasn't reached that previous high to get that breakout yet. So it's still just trying to work its way back up there. The China group if you don't want to play the individual stocks, and you just want to go after the ETF, well, it doesn't look all that good, right? This is that ETF on the daily. And we got these 2 days, real big indecision, big wicks on each side, small bodies trying to get a breakout today into what, right? There's a gap that needs to be closed here and another one up here. Maybe that one's been closed, but there's just a lot of work to get done if this is going to try to come back out again. So it could get a day trade out of it, maybe, but this doesn't look good. Pot stocks, they're up a little bit, not enough. They need to get up there a little bit more. And we don't want a rally based on pot stocks. Bitcoin's moving in the right direction, but that's not enough to even get me to look at Bitcoin miners, let alone Bitcoin players. So we need more out of it if we're going to be focused on that. So we've still got a market with a lot of indecision, a lot of unknowns, waiting on headlines and announcements and jobs and GDP. Airlines down, chips, those two as a group are really good plays. Airlines have been a good short. Jets doesn't look that great as a short from here, but some of those airline companies were closer to the highs. So could make for some continued shorts in airlines. Chips, collectively as a group, they're all getting kicked in the face. With the tariffs on autos, people working on their cars, those companies that help people with that, they could do good. What, AutoZone, O'Reilly's, those sort of things. And selling old cars, companies that do that could likely do better, right? If new cars coming in are going to be tariffed and their costs are going to be higher and those companies are getting impacted, then focus on companies that are dealing with cars that are already in the US, either to help them continue to, be roadworthy or to do resales. It's another way to play the tariffs, right? Utilities are down. Speaking of utilities, XLI yesterday, somebody pointed out some significant positioning in XLI industrials, and it was negative in its bias, in its build. That's generally what we would expect if money was going to rotate back into risk-on status, right? Out of the utilities, out of defensives, industrials, and into something like consumer discretionary, financials, technology, chips. But that's not what we're seeing. So the concern is that we'll get a highly correlated market where everything is moving in the same direction. But generally, when we get that highly correlated market, the direction happens to be down. Not really what we all want to hear. But that's when the market tends to agree the most. So when they really correlate and everybody's on the same page, that's usually the page that they're following. We can see bonds breaking down underneath the year-to-date VWAP. We've done this earlier in the year already. At some point, if we continue to test this, we're going to reciprocate the other side. I know it's really fancy language this early in the morning, but it just means that whatever we had on top, we will get on the bottom. So you're looking at like bonds down to 85 or 84.5, testing this low from early January. With all those SMRs and uranium and tying uranium to the data centers, this thing got lit for a while until everybody started to do the math and realized, you're not going to get new nuclear facilities in less than a decade or more. The time horizon's just too far out, even on those SMRs. So since then, uranium has had some wild swings, but I think the writing's on the wall with this. Just can't see it going anywhere unless something changes. So at this point, till we know anything better, it's still a sell the rip. Probably not what people want to hear, but that's what we got until get anything else. I'd like to say the biggest thing on the table today is the GDP and the job numbers, but that's likely not going to end up being the case because it's really early in the day when we get those, and it's like midday and a little after when we start getting into European central bank speakers, Trump doing executive orders, more central bank, and then Fed speakers late in the day. So don't get too comfortable with whatever bias you build this morning. It can easily flip and take us in the other direction at any point on any of these headlines. But first thing is 8:30 this morning. That's what I got for you guys. Be careful, be safe, watch the clock. I'll see y'all tomorrow.